Well, in the 80s, the KEO plan, the IRA, the 401k was created. Right? The IRS said, look, we'll give you an exception to the Internal Revenue Code and give you a tax deduction today because the federal government, Uncle Sam, believes that we're not saving enough in retirement, so they're genuinely concerned for us, right? We're not saving enough in retirement. So we're going to give you an exception to the taxes today so you can save money for your retirement, right? That's where it came about. Now look, if they really had my best interest at heart, wouldn't they have just lowered my taxes to begin with? Of course they would have. So do they really have my best interest at heart? You look at the IRA, the 401k, you put your money in there, and I own one. Okay? So, I was classically trained in the financial world as an investment advisor. Right, 20 years ago, I bought into it. I did everything that they trained me to do, right? And believed it. I believed it. Okay. So if you look at that accumulated money, if the underlying investment did well, and now you're going to take money out in retirement, you're going to pay taxes in a higher tax bracket. A third of that whole account value was eat up in fees to Wall Street. Right? And you're going to wind up with about a third of it. And the whole time you paid all the fees and took all the risk over that whole time period. There are no exceptions to that. You know, what's new in the world? We pay for everything. We take all the risk. Okay, so the comparison, I'm saying that with the infinite banking concept, you can build money in a tax-free environment that's based in contract law, not an exception to the Internal Revenue Code. And then I have access to the money without risk, within limits, and then I can use that money to do whatever I was going to do anyway, whether it's take a vacation, buy a car, buy real estate, pay for education, pay for weddings, whatever I was going to do anyway. As individuals, everybody in the room, everybody in this building, everybody that you met in the last week knows that there's something fundamentally wrong in our economy. Would you agree with that? Right? We all know that there's something fundamentally wrong, but there's not one out of 100 that could tell us why we're here, how we got here, and there would be no possibility of an explanation of a solution. Would you agree with that? So, you know, we all know that there's something fundamentally wrong in our economy, and 99 out of 100 people can't tell us why we're here, how we got here, and how we can get out of here. Okay? And if you look at what's going on in the big wide world, you know, they're all printing money. The central banks are printing money without an end, right? Are y'all familiar with the fractional reserve banking system? Okay. You know, inflation, the rising cost of goods and services, that's not what inflation is. Inflation is an expansion of the money supply, resulting, what we see, the results are a rising cost of goods and services. All right, so they're printing money like crazy. They keep, you know, QE1, QE2, QE infinity. They're doing it in concert with the other central banks around the world, the Bank of Japan, right, the Bank of China. They're inflating their currency too. We're all doing it together. And then taxes, right? We all pay at least our fair share of taxes, right? All right. So, all right, they're printing money like there's no end. Every time they print money or increase the digits in the money supply, it devalues the dollars that we already have possession of. Right? And then taxation, my opinion is onerous taxation is nothing but theft of private property. All right? The federal government doesn't produce one product. They don't produce one service. Right? They raise wealth or money in one primary way, through taxation. Call it tariffs, fees, licenses. I don't care what kind of name you want to put on it. It's a tax. Right? Then the other thing that they do is create money out of thin air. Right? Now I have a fair question for you. Would we agree that the federal government can print just about as much money as they want to? Right? They pretty much proved that. Okay. Well, then you tell me, here's a fair, legitimate question. If they can print all the money that they want to spend, Why are they taking my money and your money through taxation?
Control.
Thank you. It's complete social control. That's my opinion, right? It's complete social control. If they can print everything they need to spend, then it's social control. And you can make the argument, well, they're trying to not let inflation get out of control, and they're taking some money out of the money supply, right? No, it's social control. And I'm not a proponent of tax avoidance at all. Right? Nothing that I say today is going to talk about avoiding or evading taxes. I mean, I don't think we should any of us pay more than our fair share of taxes, but there's nothing about tax evasion here. I pay all my taxes as soon as possible, right? Because then it's my money. I don't really play their game about tax avoidance at all. Okay. Now, if they're destroying our wealth through taxes and inflation, and how is that affecting us? You look at the big wide world today, listen to the financial gurus, and they're telling you this is the message that you're hearing and is being reinforced throughout TV, radio, any kind of educational seminar that you pay attention to. It's work hard, pay cash, and then cut your lifestyle so you can save some money, and then make an investment so you can outpace inflation. And if you're going to do that, you might as well put it in the market and get a tax deduction today to do that. Put it in a qualified retirement plan, right? So you can save money in the future. And if you look today, the majority of Americans hold their wealth in qualified retirement plans in their primary residence, right? Does that sound familiar? Work hard, pay cash, and put your money in a qualified retirement plan. I have 3 questions for you. Are taxes going to go up in the future, or are they going to go down? I've got 19, 13, 1040 forms. We're all it's accessible freely. That proves taxes, the net amount we pay has gone up for the last 103 years. Right? Tax exemptions, carryovers, deductions, and all of that changes, but the net amount in taxes that we pay continues to go up as an all-American individual. Right? And then another question. Would you rather pay taxes on a little or a lot? A lot. Right. All right. Now think about that. In a tax situation, would you rather pay taxes on a little money today or let that grow into the future and then pay taxes in the future on a lot? All right. You'd rather pay taxes on a little? Is that what you said? I agree with that. Okay, so if you participate in a qualified retirement plan, you're putting money in today and postponing taxes to some date in the future. Not only are you postponing the taxes, but you're postponing the calculation. You don't even know what tax rates you'll be in the future, right? And then one more question. Is a dollar worth more today or in the future? Today. Right, those 3 questions that I just asked you violates the qualified retirement plan. We're putting money in today, right? Hopefully it'll grow to a lot. If the underlying investment's successful, you're going to outperform inflation and have a big pile of money that you owe taxes on, right? The money that comes out is going to be worth less than the dollars that you put in, right? And then you've also we've violated the law of use, if you think about that. If you tie your right hand behind your arm today and you don't untie it for 3 months, you tell me how much you're going to be able to use your right arm in the 4th month when you untie it. Right? You will not be able to use it. All right? So if you just conceptually and on purpose, I don't have a bunch of PowerPoints and numbers. I promise you I can beat you to death with numbers and PowerPoints, right? And I don't want to do that. Look, I married a beautiful girl from Iowa. She's an English major. And so if I start talking about numbers and money, and her eyes start glazing over, right? Well, when she starts trying to correct my grammar and take the southern drawl out of my speech, my eyes start glazing over. So on purpose, I'm not trying to beat you up with numbers. Okay. the law of use. If the majority of Americans' money, wealth, is in their homes and in qualified retirement plans, then they have separated themselves from the majority of their money. Okay? You want to get equity out of your home, you got to go jump through all the hoops of the lending system, right, to borrow money against the equity of your home. If you want to access money from your qualified retirement plan, you're going to pay penalties and taxes unless you're borrowing money from your 401k. Right? And then the IRS dictates how much you can borrow, how long you can keep it out, and how much interest you have to pay back. All right? Are y'all familiar with that? Perfect. All right. The infinite banking concept is, and I'm talking about the qualified retirement plan because this is where the majority of Americans build their wealth, and then I'm using that as a contrast to the infinite banking concept. Okay? If all my money is tied up here, the majority of my wealth is tied up here, and I have a health issue, a crisis in my family, or maybe I want to go back to college, or I want to fund college for a family member, so there's a medical condition or an educational expense, or maybe I'm going to move, maybe I lost my job, I don't have access to my capital, I'm beholden to the third-party lender, whoever that is, the bank, the 401k company, whoever they are. Right, my capital's here. I'm beholden to the third-party lender. Now I'm going to borrow their money to do whatever it is I was going to do. Or if there's a crisis and I don't want to borrow their money, then I'm going to liquidate the assets that I built up in a qualified retirement plan. All right, now if I've become hurt and unemployed, I'm not going to be able to pull the equity out of my real estate. Right, so I'm going to have to liquidate the qualified retirement plan. All right, and if you look at the qualified retirement plan, 70% of all plans liquidate fully or partially prior to retirement. And that's a fidelity statistic. And why? It's because life happens, educational, medical, whatever. All right, now the comparison to that is the infinite banking concept. All right, and how many have heard of the infinite banking concept? All right, one, two, three, 4 out of a room full of people. I don't know, there's maybe 30 seats in here, and they're all full, and I'm appreciative, right? Why haven't you heard of the infinite banking concept? All right, and I think it's kind of on purpose. All right. Now, if I can build wealth tax-free, right, then there's no destruction of my wealth through taxation. And if y'all familiar with the Laffer curve, right, Art Laffer? I demonstrate the Laffer curve on a DVD that we have available here mathematically with a visual calculator. The Laffer curve just says, Art Laffer told Ronald Reagan in the 80s, he said, look, if you'll reduce the rate of taxes, the federal government will have more revenue, right? Which is a true statement. You can go through the numbers. I understand by choice. They don't care to understand it, right? All right, so if my wealth isn't being eroded through taxation, and if you look at taxation destroys twice as much wealth as it redistributes. Because as soon as I pay taxes on it, then I don't have it available to profit with. Me, you, all of us, okay? So if I can build my wealth in a tax-free environment, right, that's private, I own it, it's based in contract law, which you consider what the qualified retirement plan is. It's an exception to the Internal Revenue Code. The Internal Revenue Code started in 1913, the same year that the Federal Reserve banking system was enacted. Right? The same year the 17th Amendment was enacted, where the state legislators no longer send the senators to the national level, right? You think about that, and I digress a little bit, but all that does is it weakens control at the local level and increases control at the national level. Right? This is all by design. It wasn't an accident. Okay. Now, if I can protect my wealth or just have access to my wealth without the erosion of taxes in contract law, not an exception to the Internal Revenue Code, which is exactly what a qualified plan is. If you think about that for a moment. Early on, it was really after World War II, all of our soldiers are coming back. The government, the employers are saying, how can we give a benefit or how can we give a raise to all these soldiers? Well, if we can't give a raise, we'll give them benefits. The defined benefit plan, the deferred benefit plan, the defined comp plan. These are retirement plans, right? That's the genesis. Well, in the 80s, the KEO plan, the IRA, the 401k was created, right? The IRS said, look, we'll give you an exception to the Internal Revenue Code and give you a tax deduction today because the federal government, Uncle Sam, believes that we're not saving enough in retirement, so they're genuinely concerned for us, right? We're not saving enough in retirement. So we're going to give you an exception to the taxes today so you can save money for your retirement, right? That's where it came about. Now look, if they really had my best interest at heart, wouldn't they have just lowered my taxes to begin with? Of course they would have. So do they really have my best interest at heart? You look at the IRA, the 401k, you put your money in there, and I own one. Okay? So I was classically trained in the financial world as an investment advisor. Right, 20 years ago, I bought into it. I did everything that they trained me to do, right? And believed it. I believed it. Okay. So if you look at that accumulated money, if the underlying investment did well, and now you're going to take money out in retirement, you're going to pay taxes in a higher tax bracket. A third of that whole account value was eat up in fees to Wall Street. Right? And you're going to wind up with about a third of it. And the whole time you paid all the fees and took all the risk over that whole time period. There are no exceptions to that. You know, what's new in the world? We pay for everything. We take all the risk. Okay, so the comparison, I'm saying that with the infinite banking concept, you can build money in a tax-free environment that's based in contract law, not an exception to the Internal Revenue Code. And then I have access to the money without risk, within limits, and then I can use that money to do whatever I was going to do anyway, whether it's take a vacation, buy a car, buy real estate, pay for education, pay for weddings, whatever I was going to do anyway.
If you found this video helpful, please leave a like. And if you want to see more videos like this, you can subscribe to the channel. If you want to learn more about infinite banking, you can watch this video next, or visit our website at bankingwithlife.com. Thanks for watching. We'll see you guys in the next one.